Well, good afternoon, and I'm Senator Jerry Klein from North Dakota. I'm the NCOIL Chairman at Large, and I'll be chairing this meeting today. And I'm going to start with asking for a motion to waive the quorum requirement. Motion, second. All in favor of the motion say aye. Opposed, no. Motion carried. I need a motion to approve the minutes of the last meeting. Is there a motion to approve the minutes? I have a motion. Is there a second? I have a second. All in favor of the motion say aye. Opposed, no. Motion carried. Okay, committee.
Got it.
We're going to start today with a presentation on Retirement Security Bill of Rights. And with us today is Brendan McCarthy of the TIAA. And you've also received a draft in favor of encouraging a redesign and the use of lifetime income investment solutions in defined contribution plans that has been distributed before you. So there currently isn't a sponsor attached for the resolution, but it's been drafted by the TIAA for discussion purposes, and we hope will be developed throughout this current year. So we're going to hold our questions for Brendan until he's finished. And thank you for being here, and please go ahead.
Jerry, thank you, and thank you everyone for your time today. I'm Brendan McCarthy with TIAA. For background, I think most are probably familiar with the firm, but TIAA is the largest insurer in the U.S. based on AUM. We are the largest provider of guaranteed in-plan lifetime income, and we are the fourth largest provider of retirement plans. So what I want to talk about today is a little bit some of the challenges that are facing the U.S. retirement system, and specifically the need for lifetime income. And do we have someone working the slides here? Oh, is it right here in front of me? Thank you. So the goal of any retirement plan in the U.S. is to replace 80% of pre-retirement income, and to do that through a combination of both Social Security and the retirement plan. Unfortunately, with that today, that is out of reach for a pretty significant percentage of Americans. That is, and you'll see here three of the major challenges, or we like to call them gaps, facing the U.S. retirement system. They're the coverage gap, the savings gap, and the lifetime income gap. Coverage gap, that is access to employer-sponsored retirement plans. Today, 57 million Americans still do not have access to an employer-sponsored retirement plan or a workplace retirement plan. This is something that a number of the states have already started to take action on, and we've seen that through these mandatory state IRAs. In fact, California here, 2018, I believe, started the Cal Savers mandatory IRA. A number of other states have done that, and even more so have it in process. Those have been a success. I just want to, you can look at some of the numbers, but know with the numbers that you see on these, that I work in the retirement plan industry. The states that have enacted those legislation on the mandatory IRA, they have seen the highest increase in 401k sales. It's almost a gold rush if you're in the small market 401k. So those small employers, they're looking at those, they're saying, I don't want to, I don't want to do that. I could actually do a 401k plan, it's easier. And so it is driving business in. That one is working, and it's working at the state level. Savings gap. When employees do have access to a retirement plan, they are unfortunately not saving enough. So this year, 40-year-old people in their 40s with somewhere in the range of 2 to 5 years experience at an employer, on average, have only $38,000 sitting in their retirement plan or their 401k plan. So employers are not saving enough. Employees are not saving enough. There's some legislation at the federal level that I'll talk about that's addressing that gap. And last is what we want to talk about today. That is the lifetime income gap. 60% of non-retiree Americans think they will not have enough income in retirement. I can tell you this is massive in the private sector. Private sector today, only 12% of Americans that work in the private sector have access to guaranteed income. In 1975, that number was 70%. So that's guaranteed income has all but gone away in the corporate private sector 401k plans. there is a massive boom right now for that to come back, with both products and retirement plan providers starting to build to support guaranteed income through 401k plans. Some of the other risks that are out there in the retirement system, first is longevity risk. Americans are living longer today, and this risk keeps increasing that Americans are going to outlive their retirement savings. This is sometimes masked too. We say when you're looking at longevity risk in the retirement industry, you don't want to look at just U.S. life expectancy data. When you were looking at it from the view of a retirement plan, you are concerned with those that have reached age 65. And an unfortunate statistic out there is that 30% of Americans today do not reach age 65. So they skew that U.S. life expectancy number. When you're dealing with a retirement plan, you want to look at those that are reaching age 65. And for those that reach age 65 today, there is a 46% chance that one out of a couple will reach age 95 or longer. For an individual, it's 25% chance of living to age 95 or longer. So there's an increased risk that Americans are going to outlive their retirement savings. You also have market risk. 2008 to 2009, we saw a 47% drop in the U.S. equity market between it was October and March of 2009. That drop was so significant that if you remember at the time, Congress actually held hearings to look into U.S. retirement plans and specifically target date funds. They were saying how were Americans that were this close to retirement losing this much of their retirement savings. So you have that market risk, and that's something that can be addressed with lifetime income. Cognitive, obviously, is increased cognitive decline. 1/3 of Americans age 65 or older have mild cognitive impairment or dementia. And last is inflation risk. We've seen that probably more evident the last couple of years. That is something that reduces their spending power, in their purchasing power in retirement. So as mentioned, Congress at the federal level has been addressing this. There has been an unprecedented amount of retirement legislation passed the last 4 years. Over 120 provisions through 2 acts. First was the Secure Act, December of 2019, stands for setting every community up for retirement enhancement. And then there was Secure 2.0, which was passed in December of 2022. The provisions in these bills were designed to hit those 3 gaps. Number 1 was the access gap, help more Americans. There was a number of tax credits there that encouraged employers to start, small employers to start 401k plans. Second was to help that save more aspect, that savings gap. Defined contribution plans or 401k plans going forward are required to have auto enrollment and auto increase. So you're automatically enrolled into the plan. Your amount that is deducted is automatically increased each year. Now, at any point, an employee always has the option to opt out, but you're defaulting them in so that their own behavior does not work against them. Third is lifetime income. There were safe harbor provisions passed in Secure that made it easier for defined contribution plan sponsors, ERISA fiduciary plan sponsors, or employers to utilize annuities inside of 401k plans and other 457, any ERISA-sponsored plan. That legislation has caused, that was 2019, that has increased. What it's led to is the retirement plan providers out there, the ones who administer these retirement plans, have been building the technology, and that's now going into production to offer guaranteed income, as well as the product manufacturers can now offer guaranteed income through what we like to call the default fund, and I'll talk about that in a minute. Now, the impact of this on the states, or the impact of not incorporating lifetime income, not addressing these measures, it equates to $334 billion in increased aggregate spending at the state level. In fact, when you combine state and federal, it's estimated to be upwards of $1.3 trillion in additional expenditures that this will result in. So why lifetime income? First is employees. Employees are looking for lifetime income. I think most evident, if you saw in the UAW negotiations, it was a demand last year to bring back that guaranteed lifetime income. 78% of respondents to an EBRI, that's the Employee Benefit Research Institute out of Washington, D.C., responded saying that they were looking for lifetime income. 75% said that they prefer income stability in retirement over principal preservation. Plan sponsors, as an ERISA fiduciary plan sponsor, incorporating guaranteed income can help increase the risk return profile of the retirement plan that you offer. And last is it allows for the potential of increased spending. Now this, I'll explain this one here, but adding guaranteed lifetime income generates 29% more in annual spending ability from one's retirement savings and reduces downside risk by 33%. The spending piece, we are seeing this, and we're hearing it more and more from FAs and some financial advisors, and you may actually be dealing with this yourself. When you do not have enough guaranteed income, you tend not to spend. In fact, we hear from financial advisors that people's biggest regret was they had too much money. They're now in a position where they're not able to enjoy it. They wish they had taken that trip with the family. They wish they had, they can't go back in time now and redo things. That is because people without guaranteed income are worried about outliving it. I will just say personally, I live up in New England. I'm from Massachusetts. My father is 79 years old, and I get a call every winter from my mom to come over and try to convince him to turn the heat on. He tries to go to Thanksgiving before turning the heat on in the house. It's that level, and the driver of that is he is worried about running out of savings. He does not have guaranteed income. So that is often known when you have it as a license to spend. If you know you are covered, and as long as you live, you are not going to run out of income to cover your essential living needs, you are way more likely to spend in retirement. So on this, I talked about the technology earlier this year, and this is one of the hottest things in the retirement industry is now this ability to provide guaranteed income through a retirement plan, through a defined contribution plan. I mentioned TIAA is the fourth largest provider of lifetime income. We've always had the technology and the ability. We've been providing guaranteed lifetime income through defined contribution plans since 1918. Our competitors out there, both Fidelity and number one largest provider, Empower, number two and number one with state plans. They both earlier this year announced that they have added lifetime income offer. Empower actually is offering our lifetime income offering. They're offering it, and Alight is the number three. They're in the process of building it. So the technology is there now for this to be delivered. The other thing is this can be delivered simply. It's not complex. These solutions are being embedded inside of the default target date funds so that investment that they are being defaulted into inside of the defined contribution plan works the same way it always did, but now you can convert a portion of your retirement savings. You don't just have a balance, you still have that same balance, but you can now convert a portion of it into retirement income. One other part on this, they do not necessarily, there's a number of solutions in market now, they do not necessarily need to increase costs. In fact, some of these income solutions can actually lower the overall costs of the retirement plan. And additionally, having it increases income in retirement rather than a lot of people today rely simply on a 4% withdrawal rule. So what can states do? I know we have the draft resolution in front of you. Please reach out to us. We'd love to work with you on that. But on your state retirement plan, number one is just ensure that your employees, state employees, are participating in the plan. Sometimes that requires additional promotion of it, other marketing to just make sure, and other kind of structural designs to make sure they're participating in the plan. Second is driving adequate savings. You want people saving 12 to 15% of their retirement plan, and you can do that through auto escalation, as we mentioned earlier. Offering core investments, including lifetime income. Again, now you can get those target date funds that all of your state plans most likely have as their default fund. You can get them where they actually embed the guaranteed income inside. And last is driving employee engagement. Communicating this, it's viewed as a benefit enhancement. You may now have, in addition to your DB plan, you've got additional supplemental guaranteed income so that you can meet that 80% desired income replacement. Some of the states here you'll see that have already taken this on, New York, North Dakota, Rhode Island, and South Carolina have all moved forward with lifetime income options inside of their defined contribution plan. So again, in terms of what to do, we have the draft resolution. Take it back. This is meant to be a guide for you, but I would just take a look at your state's retirement plan offering, see how much lifetime income is being generated by the defined benefit plan, is it enough, and with your defined contribution plans, is there enough for that 80% income ratio? If the typical DB plan doesn't offer enough, can you then include that? Can you easily get to that 80% by incorporating that into the defined contribution plan, whether it's the deferred comp 457 or whether it's a hybrid or a state DC plan? Again, happy to help everyone here on this. Up takes questions. Also, feel free to reach out to me on LinkedIn. It's Brendan McCarthy, TIA. You'll find me pretty easily out there if we can help in any way. So thank you for your time.
All right, and thank you. And any questions? Any questions for Brendan? Senator Hackett.
Yeah, and it's what I do for a living, and so I've done it for many, many years, and we manage a lot of monies. The one thing, we have 5 public plans in Ohio. They're all defined benefit plans.
Right.
Even though you have some options that you can do different things. The problem is, it's health care, and we have there's nothing in a Ohio revised code. I mean, when I was a state rep, we brought the plans into compliance, which we needed to do. But it was the board of directors of the 5 public plans that created the problem. And a teacher, for example, in our STRS, the State Teachers Retirement System, they could retire at any time in 30 years, where so many teachers started at 20 and 21, we're going to retire at 50, right. 51. The problem was, what is the cost of health care to get them to Medicare? That is the problem on the plans. And we have no responsibility or authority or anything on health care. It's the 5 public plans that did that. I mean, I see what you did, and I understand what you did, but there's a cost to everything. I mean, you used how bad the market dropped in 08 and 09, but you didn't put how much the market has come back since then. You know that. I mean, and how much the market jumped. You know, you could do from 2000 to 2002 where the market dropped, but look at the things. The market usually comes back. And so all I ask is to be fair. The problem of a guaranteed lifetime income is the cost of it. You got to do it right.
Correct.
And you know that, and I know that. It has to be done right. And we got to be careful, you know, that we don't use annuities completely, you know, in a situation like that. Annuities, the commission on annuities is extremely high, and the cost is there. So we have to be careful on how we do this. And you know that as much as anybody knows that.
Completely agree.
So I'm not getting on you.
No,
I love
the question. You're absolutely accurate. In 08, 09, the danger was not those that kind of just experienced that drop, stayed in the plan. It was the number that exchanged out that thought this market's going to zero, and then they missed the bounce back. So that 47% for a number of Americans was even worse.
You saw a lot of the growth things worldwide were 55. I mean, it was even more than 47.
That was unrecoverable.
I mean, it was, but it came back strongly. Yeah, and that's why the consumer a lot of times chases the market, and you and I know that is completely wrong, completely wrong. And so that's why I'm not just a pension rep, I'm an investment advisor. So I can give pension advice to people and say, you don't buy it to sell it when the market drops under that scenario.
Agreed.
You give it time. But, you know, I just I just warn you a little, because it isn't always the solution of having the guaranteed income. The
Yeah.
solution is getting people to put more money away.
It is. It's a
The
combination.
problem is healthcare.
Right.
In the private sector, we don't, you said, we don't have defined benefit plans.
Right.
Only in the state-run systems are defined benefit plans.
Right.
Or some of the, maybe the major corporations, but even they've gotten away from it. So
Well,
I just want you to be, careful to the people in here.
No, I appreciate that. While this can't solve for the health care, it can help a little towards it. That is a larger issue,
know.
without a doubt. I will say on cost, there's a number of different solutions, but there are solutions out there that do not increase the cost, that can actually lower the cost.
Yeah, and I agree with
All right.
you.
Yeah.
And Representative Hefner, if you have a,
Go ahead.
right,
I'm done.
All right.
I'm
all right, any other questions? Any other questions? Brendan, I'm sure Senator Hackett will meet with you after the meeting and give you some other additional
He'll
pointers.
avoid me.
I will be around
you
and
did
happy to
great
talk.
company. They're great
Yeah,
company.
happy to talk to anyone afterwards. Thank you
All
so
right.
much.
All right, and thank you. Thank you so very much. Next on our agenda is a presentation on Transamerica Center for Retirement Studies and the Annual Retirement Survey. With us here today is Catherine Collinson, CEO and President of the Transamerica Institute and Transamerica Center for Retirement Studies. And once again, we'll hold our questions till she's finished. And Catherine, thanks so much for being here, and please go ahead.
Oh, thank you for having me. I'd like to spend our time together talking about a survey report we released just last month. It's called the Multi-Generational Workforce, Life, Work, and Retirement. We surveyed, this report is based on a survey of more than 5,700 workers of for-profit companies. And I don't usually do this in my presentations, but I have to add this little footnote. We did not inquire about political affiliation, so I cannot answer any questions. We engage Harris Poll, which is one of the largest online panel survey firms in the country. So this is a nationally represented survey, and these are our findings. A quick note, we're a nonprofit private foundation that is funded by Transamerica, and our retirement survey, which I'm talking about, is one of the largest and longest running of its kind. So Brendan actually touched on longevity, and one of the things that we're all seeing in our research and our society is people have the potential and are living longer than we've seen ever before. And this has tremendous implications for how we live, how we work, how we retire, and everything from healthcare has come up to retirement savings. We view successful retirement as the combination of healthy aging and financial security. In many ways, they are two sides of the same coin. When we ask workers how long they are planning to live to, and it's an awkward question because a lot of people don't think about that if they're not actuaries, 1 in 7 are planning to live to 100 or older. The median age of those who provided a number is 88, and then of course 34% are not sure. I'm going to start with the health side of the question and then take a deeper dive into what's happening with retirement savings and retirement security. The good news is 3 in 4 workers have close relationships with family and friends, are happy and enjoying life. And this is probably some of the best news that we see in the survey. When we look at overall sort of what we call positive feelings as well as indicators of distress, I've covered the positive. I've got to notate some of the indicators of distress. We see high percentages of people saying that they're having difficulty making ends meet, and that number is especially high for Gen Z, the youngest generation in the workforce. We also see among Gen Z, and to a lesser extent millennials, is many are feeling, often feel anxious and depressed, And then Gen Z, the youngest generation, very high percentages say they often feel isolated and lonely. So we are seeing a social isolation, the effects on mental health, and we've seen the Surgeon General's report on the loneliness epidemic. I think this is something that we really need to pay attention to because it affects their quality of life, it affects their health, it affects their productivity, and their ability to save for retirement. I'm going to just touch on most workers are in good or excellent health. We inquire about healthy behaviors that they are engaging in on a consistent basis, everything from the basics of eating healthy, exercising regularly, getting plenty of sleep. And we see more than half are doing those, at least the first couple of things. And then there's other things people could be doing to protect their health that they're not engaging in. You can see the percentages, not seeking medical care when needed, not keeping up with routine physicals and health screenings, as well as only 38% indicate they are avoiding harmful substances, which in the question we say, e.g., cigarettes, alcohol, drugs. Older workers tend to be taking care of themselves better than younger workers, but still, what I see here is a role for public health, that our education campaigns are always going to be a work in progress, and for current generations as well as for future. Now we're going to shift gears to retirement. One of the things that we've seen in our survey, and I've also been involved in global retirement research, is in the U.S., people love retirement. Positive word associations, workers are twice as likely to cite one or more positive word associations as negative word associations, and it's really something that people strive for, save for, and look forward to. And in the spirit of longevity, the workforce is already rethinking their time in the workforce relative to retirement. And something that we've seen in the survey for a good 15 years now, our work and retirement are no longer mutually exclusive in the minds of workers. They're envisioning a gradual transition versus an all or nothing, work full-time one day and never again the next. Almost half expect to retire after age 65 or are not planning to retire. And when we look at older generations, of course, many baby boomers are already doing that. In Gen X, far more than half are looking to work beyond traditional retirement age. And then across the board among generations, more than half say they plan to continue working at least part-time in retirement. However, there is a catch. One is, will there be employment opportunities available? And then, I'm going too fast. I'll touch on that. But and they want to do so for both financial reasons as well as healthy aging reasons. It's probably not surprising that 4 in 5 cite one or more financial reasons, but it's almost as many, 78%, are citing healthy aging-related reasons, ranging from being active, keeping their brain alert, having a sense of purpose, enjoying what they do. However, the kicker is this: will there be employment opportunities for them, and are they being proactive enough so that they can continue to work as long as they want and need? And I've just pulled these three. There's a longer version of the question in the survey, but fewer than 6 in 10 say they're focused on staying healthy so they can continue working. Particularly concerning to me, only half of workers say they're keeping their job skills up to date. We know the world of work is moving very, very quickly right now, and if we don't all strive to keep our job skills up to date, we're at a big risk of getting left behind. And then as you see, fewer than 3 in 10 are networking and meeting new people, which are essential for getting leads on job opportunities and even having an understanding of what employers are looking for. Workers face competing financial priorities. Some good news is when we ask about current financial priorities, the highest response rate is on saving for retirement. Again, this finding is skewed towards millennials, Gen X, and baby boomers, whereas Gen Z, many are saying that they're just getting by to cover basic living expenses. Another thing I want to point out about Gen Z is in our research, and this is an emerging trend, but it's something that we're starting to see sort of ooze through the data, and that is when we ask this series of financial priorities, among Gen Z, 1 in 5, 20% said supporting their parents, which is suggesting that absent adequate savings of older generations, the burden is starting to fall on their adult children, who at a point in their life where they're trying to build their own financial base to carry them through their working years. Good news, and again, these are employed workers of for-profit companies. 4 in 5 are saving for retirement, either through their employer's plan or outside of the workforce. And the savings rate is 4 out of 5 for millennials, Gen X, and baby boomers, but a really exciting proportion of Gen Z, 71%, say they're already saving for retirement, which is remarkable. However, that takes us to something that, along the lines of what Brendan touched on, only 20% of workers are very confident they're going to be able to fully retire with a comfortable lifestyle. And this is something that we see across all 4 generations to a greater or lesser extent. Their greatest retirement fears, and I'll add that older workers who are closer to retirement are more likely to have fears than younger workers when retirement is a bit further away. But the biggies are outliving their savings and investments. There's anxiety about the future of Social Security, as well as the high cost of, or actually health issues later in life and the potential need for long-term care. We did have an outlier in the findings generationally, and Gen Z, and it caught me by surprise, one of the options that's not cited by all that many, when we look at the numbers in their totality, 4 in 10 Gen Z cited feeling isolated and lonely as one of their greatest retirement fears, which just sort of reinforces that we've got to pay really close attention to the mental health of the younger generation. Expected primary source of retirement income, which I've laid out here. We ask workers about all of their expected sources of retirement income, and then what will be your primary source of retirement income. These are the overall findings. There's some big results generationally, whereas baby boomers are far more likely to cite Social Security as their primary source of retirement income, whereas other generations are more likely to indicate income from 401ks, 403bs, and IRAs. One thing I want to touch on, because this is such a central topic today, is retirement plan coverage. And we ask workers in the survey, which of the following retirement benefits are offered to you personally by your employer? And we can see that a high percentage, 3 in 4, are offered a 401k or similar plan, some sort of employee-funded means to save for retirement in the workplace. And because there is so much focus on closing the coverage gap, we had to pay really close attention to who is not covered. And what we see in our research is it is typically workers of the smallest companies, part-time workers, and lower income workers. Across large companies, the access rates are very high. One thing I'm really enthusiastic about, and indicative of how the defined contribution system is working, is we're seeing emerging super savers. So among workers offered a 401k or similar plan, we see very high rates of participation, 4 in 5, and then when we ask how much of their salary they're contributing to the plan. The median is, among those participating, the median is 10%. And Gen Z, and this is the second year in a row that we've seen this, so we've seen really high percentages among Gen Z workers who are taking advantage of the retirement plans. How this relates to household retirement savings, and again, this is of all workers, regardless if they're offered a plan or not, and we ask about savings in total household retirement accounts. We can see that Gen Z is actually getting a strong start, whereas millennials, having saved $50,000, these are estimated medians, are making progress. Gen X and boomers, I'm very worried about. Generation X, it's hard to believe the first Gen Xers are going to start turning 60 next year, and all indicators are many are behind in their savings. A few opportunities I wanted to point out to strengthen savings. One is financial literacy. Only 21% of workers say they have a lot of working knowledge about personal finances. And then another one I just want to focus on for a second is many workers are saving, but we're seeing a high percentage tapping into their savings before retirement by taking a loan, hardship withdrawal, and/or early withdrawal. 35%, and those percentages are pretty high across the 4 generations, including the youngest savers, Gen Z. It seems like they haven't saved long enough to have to need to dip into their savings, but we see it happening. I'm going to wrap this up with just a couple more sets of insights. We asked workers their priorities for the President and Congress to help people have a financially secure retirement. And what comes to the top of the list, and we've asked this question in prior surveys, is strengthening our social safety nets, especially as it relates to Social Security and Medicare. People are really counting on those. And this is also reflective of sort of the broader ecosystem. If we think about successful retirement being healthy aging and financial security, there is a pretty high response rate on ensuring all workers have access to retirement benefits in the workplace or retirement plans in the workplace. But it's interesting to see where it stands relative to some of the other priorities. So my 5 key takeaways for you, based on our survey findings, is first of all, public policy is absolutely essential for fostering an environment that's conducive for successful retirement. The second takeaway is workers understand the importance of saving for retirement, but many are still at risk of falling short. The next is to create an environment where everyone can be successful. We need to ensure they have the tools and education and know-how to be successful. Number 4, we lean heavily on employers as a very important conduit for offering not only employment, jobs, education, training, but also the very important benefits, health, retirement, and other benefits. We lean on them a lot. However, we also have to recognize some care about it a whole lot more than others, and then there's some employers that may be just too small or not stable that just don't have the wherewithal. And so we've got to find ways to help those employees or bring those employees into the system that may not have the same level of benefits. And then finally, to strengthen our retirement system, in addition to enhancing 401ks, defined contribution plans, and other types of retirement savings, we also have to pay close attention to our safety nets. And that's it. Thank you.
All right, thank you. There was a lot of stuff there, Catherine. Any questions for Catherine? You know, as I listen to this, there's a lot of things. If you retired 10 years ago, who would have thought where the inflation period that, we're fine. You know, that was one thing that came to mind as I've gotten older. And I'm not suggesting people go back to run for the legislature so they have a part-time job, but those are things that everybody is being faced with. And I think the literacy issue is another thing where I think the youth are you know, there's a lot of fun stuff out there to buy, and saving money is probably something that we don't instill in them enough to understand. It seems like statistically it's coming, but I think we still have a ways to go. Is there anything in there that suggests that the young people are doing a better job?
Well, especially if they're offered the chance to save for retirement in the workplace, they're doing a terrific job. And I touched on the 4 out of 5 that are saving either in the workplace or outside of work. A really exciting development for me is this. The boomers who are saving, they started at age 35. When we look at the youngest generation in the workforce, Gen Z, the median age is 20. That has added an entire 15 years to their savings and investment, their long-term savings and investment horizon. So if they can stay focused and not tap into their savings, they can really take advantage of that trajectory.
All right, questions? No. Representative spokesman for Jimmy John's, Representative Bennett.
Yeah, I want to add to my client list Gen Z and millennials because my colleague, the chairman, talked about young folks, you know, having fun things to buy and things like that. I just want to offer a different perspective, and I'm sure that's true in many circles, but there are also extraordinary challenges, as we all know, for the youngest generation and for millennials. Our housing stock is not where it needs to be. Our ability to save, to begin to save at all, is difficult, and I just like to push back on that idea sometimes. Not that I think you meant anything by it, but that it's not for lack of a desire to save and be able to buy things like a house that can help you create generational wealth, that kind of thing. And I think it behooves us all as policymakers to look at that housing stock, cost of healthcare, wages. I love this organization because we really do get at the heart of some of these things, but this all exists in the context that other areas of public policy are not necessarily ideal for the consumer either. So I do wonder, in your research, if you've noticed where people are prioritizing. I saw the need to strengthen the social safety net, and I wonder how much money folks are spending in that respect that they could be putting back as a result of not having some of those sort of safety net tools that previous generations have been able to have, whether that's mortgage assistance or that's care for the elderly. I have an aging mother who needs additional care now, and we are struggling to find a way to pay for that. I'm 34, and I'm spending some of my money doing that as opposed to putting it away. So I wonder what advice you might have for us more specifically in where we would prioritize if, as many of us and many of our state legislatures don't have endless amounts of money, but where's the best place to put that money if we have to choose?
Okay, wow, that's a great question, and as a couple other things I just feel compelled to say about younger generations and Gen Z, and this goes back to when I was growing up, and I'd hear my grandparents say, "Kids these days," and it was almost universal because I hear my friends saying it now. I'm like, "What are you saying?" And what we see in the research is, especially with millennials, that was the first generation that we really saw high rates of student debt. We certainly see that with Generation Z, but we're also, in prior waves, when we asked about employment effects of the pandemic, they were more likely to get laid off or furloughed, and that was a setback for them. Where they're at now, generationally, they're more likely to be making, just getting by to make ends meet, and they're hustling. A high percentage have 2 or more jobs, a high percentage have side hustles. This is what's coming out of the data is they have a very, very strong work ethic, and also a pretty high percentage, it's at least 1 in 3, are either serving or have been serving as caregivers. So I'm really happy you brought that up. across the 4 generations right now, millennials take the top spot as the caregiving generation. Gen Z is not far behind them. And if we think about public policy, somewhere that could really help is support for family caregivers, because if they're working in caregiving, they're making, 4 in 5 are making adjustments to their employment, which could in affect their employability, their future raises, their own career development, and their own ability to save for retirement. And affordable housing is very top of mind for everybody, but especially for the younger generations wondering if they're going to be able to afford it. So,
All right, Senator Boyd.
Thank you, and this might be more of a comment or just an educational point than a question. But just a reminder, like if you have a child who isn't even 18 yet, he or she can go to work, pay virtually no taxes, invest that in a Roth IRA, and let that grow for years, decades, and virtually pay no taxes ever. So that's just something, again, a lot of it is, what are we doing to help taxpayers understand the system that we have in place, and encouraging mom and dad to work with those kids.
Representative Tedford.
yeah.
I'm curious, out of the data on the Gen Zs and millennials, whether that willingness to invest more is due to a paradigm shift in their trust in Social Security as being there when they retire.
I believe it is. I believe that's a big part of it. One of the things that we saw, and we've seen over the years with millennials, and if we just think timing-wise, is they were entering the workforce. It was about the time the financial crisis was hitting. It's many still living at home with their parents, and they saw what was happening with their parents and just being part of family units, because it was such an extremely difficult time. They've heard concerns about Social Security probably as long as they can remember. But there's also something that money and finance has captured their imagination, and I think in many ways it's access to 401ks and the ability to save. For years, when we ask workers how frequently they talk about saving and investing and planning for retirement, millennials are twice as likely as boomers, the generation that's retiring or getting close to it, to say they frequently discuss it. So millennials have a new money mindset that I think is a really good thing that could help them. And we're also seeing that bubble up with Gen Z as well.
All right. Any other questions for Catherine? Well, thank you so much for being here. Thank you for the update. Very much appreciated. All right, we're going to be moving on to our next agenda item is discussion and proposed amendments to Incoil Life Settlements Model Act. We had a good discussion on some amendments at the last meeting in April. And since then, we've had Representative Forrest Bennett sign on to sponsor some amendments. And before we go any further, I'll turn things over to him for some brief comments.
Thank you, Mr. Chairman. I'm happy to sponsor the amendments, and you can find them in your binders on page 253, 256, and 258. They're the parts that are underlined. Basically, they can be broken down into 2 categories, one being modernizing the model by allowing for electronic communications in certain circumstances, which I think benefits both carriers and individuals by saving paper and cost, and also trees, so it's pretty self-serving considering my name is Forrest. And the other is focusing on whether agents should be prohibited from disclosing the options of a life settlement when a client comes to them thinking about dropping their insurance. I've appreciated the conversations that have gone on between the folks that are involved in this and their efforts to reach a compromise, and the Zoom time that we all got to spend together. I'll never forget it. The filters were great. So because they are still having a conversation, I'm asking that we not have a vote on the amendments today, as it seems that the conversations are progressing in a positive way. But we may be able to have a vote on this in November. To that end, I would request, Mr. Chairman, that we have a conversation about this during any interim meetings that may occur between now and the fall meeting.
So noted.
Thank you so much. And really, I know that you're saying that because Will says it's okay to do that and not.
I wanted him to nod.
But anyway, I appreciate the input that everybody's provided so far, and I look forward to continuing to work with everybody to make this happen.
All right, thank you, Representative Bennett. With us here today, though, we have Josh May of Coventry and Jill Ricard of the American Council of Life Insurers. And we're going to hold questions until both are finished. So we're going to start. Josh, you want to go ahead?
Thank you for the opportunity to speak. I'm here on behalf of the Life Insurance Settlement Association this afternoon. The LISA represents life settlement brokers and life settlement providers. Overall, we believe this has been a very successful Model Act, and we're pleased that it will be readopted. We also think that after 17 years, there are a few items that should be addressed and refreshed. As our sponsor said, we put those items into 2 or 3 categories. The first is electronic communications and signatures. We don't think this is very controversial. They should be accepted. Some carriers still require snail mail, which adds significant time and inconvenience for consumers to what is already a lengthy and relatively complex transaction. So we're asking that carriers be required to accept electronically signed documents and accept electronic requests for things like VOCs, verifications of coverage, and policy illustrations. We deal with this on a daily basis in the industry and think it's a practical and pro-consumer change. A second bucket that wasn't mentioned previously is to change some of the carrier response times. We'd like to move from 30 days to 21 days in a couple of situations, and also impose a 21-day deadline for the first time for carriers to respond to requests to change the ownership of a policy. We think consumers should be able to have their transactions completed on a timely basis, and this will go a long ways towards helping make that happen. The third category relates to insurers that prohibit their agents from discussing the life settlement option. It's a small minority of carriers, but we believe it's anti-consumer and should change. To be clear, we're not asking insurers to advertise or promote life settlements. Simply, we want them to allow their agents to speak about the life settlement option if he or she chooses to do so because they think it's in the consumer's interest. I understand this is the most controversial change, and as was said, we've had productive discussions with the ACLI and plan to continue those discussions to work towards a mutually agreeable solution.
All right.
Thank you.
Thank you. Jill, go ahead.
Thank you, Mr. Chair. I'll just be very brief. We have had, like Josh said, some good conversations about this. He also mentioned the most controversial is the producer disclosure requirement, which, along with the other 2 provisions at this point, ACLI does oppose, absent what we view as evidence of consumer harm in the marketplace. But in the spirit of continuing discussions and compromise, we have agreed to take some proposals from LISA back to our members in the next couple of months prior to the interim meeting, and hope to come to a compromise, if possible, on the less controversial provisions, particularly e-notification. So appreciate the opportunity.
Well, for those of you in the audience who were here 20 years ago when we battled through this, and then we went to our states and we went home and once again worked through this. It's like reopening this can of worms that was certainly, it was an interesting time. It was an interesting time at NCOIL and certainly in our own legislatures. So with that, any questions for Jill or Josh? Any questions? Once again, this is model legislation. Each state can adopt things as they see fit, and can be, approach these issues from their own state perspective. So with that, any other questions? Seeing none, I'm going to go, Representative Bennett, thank you. If you have any questions or any concerns,
No, I just want to reiterate my appreciation to everybody that's been involved in, for being as amicable as possible and helping me get caught up to speed on this issue in the first place. And I do genuinely look forward to additional conversations and hope that we can come to an agreement on everything.
and Representative Bennett, was that a motion to adopt this till November?
Right, thank you for that part, Mr. Chairman. I would move that we extend this model for 3 months so that with the hope that in November we're able to vote on reauthorization in one way or the other.
All right, we have a motion from Representative Bennett. Is there a second from Senator Boyd? Any other discussion? Seeing none, all in favor of the motion, say aye. Opposed, no. Okay, we will take this up again in November. I think there's some work to be done. All right. Last on our agenda is a brief update on litigation surrounding the U.S. Department of Labor's fiduciary rule. All right. Some of you know the U.S. Department of Labor finalized its new fiduciary rule, which essentially mirrored a rule from several years ago that was ultimately struck down by the federal court system. NCOIL opposed both rules on the grounds that the rule is an encroachment on the state-based system of insurance. For this current rule, there's a lot of activity in the courts and in Congress. 2 lawsuits have been filed by insurance trade groups in federal district court. There's also a bill in Congress that is headed for a vote that would prevent the DOL from spending any funds to implement the rule. NCOIL will continue to monitor that activity, and we hope that the rule will ultimately be struck down as it was several years ago. So with that, is there any other business to come before the committee? Any other business? Well, committee, there's a meeting of the Articles of Organization Bylaws Revision Committee in this room very shortly. But since there's no further business, is there a motion to adjourn? Motion to adjourn, is there a second? All in favor of the motion say aye. Opposed, no. Motion carried. Thank you.